All right, let's cut right to it. Welcome to today's Daily Strategy Explainer for August 20th, 2026. Look, right now we're staring down a massive structural collision in the markets. On one side, a literal mountain of record U.S. debt issuance and completely shifting Treasury mechanics. On the other side, absolute, unadulterated euphoria driven by AI equity concentration. As institutional analysts, our job isn't just to stare at the numbers. We need to deconstruct exactly how these opposing forces are completely rewiring global asset pricing models from the ground up.
I think JP Morgan Global Research really hit the nail on the head with this one. They noted that markets are actively navigating the severe tension between ongoing energy supply shocks and a surprisingly resilient growth backdrop. That resilient growth? Yeah, it's fueled entirely by AI capital spending. So we've got to frame everything today through this exact lens: structural liquidity constraints battling head-to-head against fierce capital concentration. Here's our roadmap for today's institutional research note. We're running through a strict 6-part framework: macro sentiment and liquidity, equity market microstructure, sector strategy and alternatives, geopolitics and smart money, our strategic action plan, and finally, the final verdict and key variables.
Okay, part 1, macro sentiment and liquidity. Let's look at the structural debt realities and direct Treasury interventions.
So, the U.S. public debt has officially crossed the $40 trillion milestone. It's a massive number. But to understand the Treasury's current panic, we have to look closely at inflation. Core CPI metrics, they are stubbornly sticky. Shelter, that series CUSR 0000SH1, and services, CUSR 0000 SASLE, are continuing to drive the headline print. They're fully offsetting any deflationary relief we're seeing from used cars and trucks, series CUSR 0000 SATO2. Against this backdrop, Treasury Secretary Scott Bessent is out there signaling increased buybacks, upwards of $4 billion plus per issue, to artificially lower long-end yields. But you have to ask yourself, can the Treasury actually anchor yields against a deficit of this magnitude?
To find the truth, we go straight to the Fed balance sheet data to deconstruct the exact liquidity metrics flowing through the system. Total assets under Series WALCL sit at $6.759.955 million. Meanwhile, the Treasury General Account balance, WTREGGN, is pulling liquidity out at $963.950 million. But here is the most critical piece. The reverse repo facility, RRPNTSYD, has been drained down to essentially nothing, just $0.25 billion. Think about what that means. The primary liquidity buffer, it's gone. So despite the Treasury's buyback interventions, the underlying structural deficit and these relentless liquidity drains are absolutely dictating the harsh realities of the bond market right now.
Moving on to part 2, equity market microstructure. Let's dissect the market internals.
We are seeing a severe divergence right now that exposes extreme concentration risk. On one hand, you have Goldman Sachs projecting a highly bullish 8,000 target for the S&P 500. Why? It's entirely driven by AI earnings resilience and their $350 EPS estimates. But look at the reality of the broader market. The Russell 2000 Index, ticker RUT, closed today at 2,995.01, which is down 1.25%. This divergence is wild. It proves we are dealing with extreme concentration risk. The Magnificent Seven are dragging the headline index higher, but they're completely masking the incredibly weak market breadth underneath, where smaller caps are just suffocating under the weight of higher borrowing costs.
Let's actually quantify that underlying risk preference. The DXY dollar index is sitting strong at 98.80, continuing to act like a vacuum on global liquidity. However, when we look at the high-yield option-adjusted spread, series BML HO80HYM2, it remains remarkably tight at just 2.73%, and the VIX volatility index is totally subdued at 14.89. So what does this tell us? It means that despite the massive liquidity drain, systemic credit stress hasn't triggered yet. Equity markets remain stubbornly comfortable, for now.
Which brings us to part 3, sector strategy and alternatives. Let's track the capital rotations.
When you look at the raw performance data for all 11 GICS sector ATFs, the rotation is crystal clear. The bulk of the market is deeply in the red. We've got technology, XLK, down 0.27%, financials, XLF, down 0.92%. We're seeing heavy hits in healthcare, XLV, down 1.85%, and consumer discretionary, XLY, down 1.61%, and that weakness just bleeds through the rest. Consumer Staples, XLP, down 1.41%. Industrials, XLI, down 1.23%. Materials, XLB, down 0.19%. Utilities, XLU, down 0.56%. And Communication Services, XLC, down 0.57%. Capital is aggressively retreating and finding highly selective shelter in literally just two areas today. Energy, XLE, up 0.28%, and real estate, XLRE, up 0.20%.
Looking outside of equities, the alternative signals are flashing bright red. WTI crude, series DCO ILWTICO, is trading at $86.56 a barrel. Alongside this, gold futures, GC is equals F, have absolutely surged to $4,584.70, up 2.12% on the day. We are interpreting these isolated movements as critical inflation and risk-off signals. Central banks are loading up on physical gold, and the market is visibly pricing in deep supply anxieties in the energy sector.
Furthermore, we absolutely must look at digital assets. Bitcoin, ticker BTCUSD, is currently trading at exactly $72,700.00, marking a solid positive 4.96% increase for the day. This isolated surge is a direct reflection of aggressive risk-on sentiment in the digital asset space, which is heavily linked to the anticipation of incoming regulatory certainty from the Senate's scheduled September 15th vote.
All right, part 4. Geopolitics and smart money. Time to filter the global noise.
As institutional analysts, we have to strip away the emotion from the headlines. The ongoing UK and Israel E1 settlement dispute, the intense US political rhetoric ahead of the midterms, the upcoming legislative battles, we quantify these purely as catalysts. Middle East tensions? They translate directly into energy price volatility and risk premiums on crude. The US election partisanship and that September 15th Clarity Act vote, those translate directly into legislative market structure changes that alter institutional risk parity models. And honestly, the smart money is deeply divided on how to price this environment. Contrasting Goldman Sachs' aggressive S&P earnings estimates, we have this absolutely crucial warning from Dubravko Lakos-Buyas at JP Morgan. He points out that the upward path will be nonlinear, highlighting that extreme crowding in the momentum factor is at risk of a reversal. JP Morgan is maintaining structural caution regarding this momentum crowding, especially in the face of rapidly increasing equity supply constraints. It's something we simply can't ignore.
Let's move to part 5, the strategic action plan. Here are the binary outcomes.
So, we're looking at two distinct operational scenarios. Scenario A, the bullish case, is a momentum continuation. If earnings resilience holds up, you remain overweight in tech and AI. Plain and simple. Scenario B, however, is the ultimate bearish trigger. If the 10-year Treasury yield breaches and sustains above the 4.75% threshold, it's going to trigger immediate valuation contraction. If we see that scenario play out, you must immediately underweight broad equities and actively hedge your portfolio with gold and energy.
And we most explicitly warn of the primary tail risk currently lurking in the shadows. A black swan event right now is defined as a severe geopolitical escalation in the Middle East, resulting in a sustained physical volume shock in the Strait of Hormuz. If this pushes WTI crude to $150 a barrel, it represents an energy supply shock that current equity valuations have entirely failed to price in. Literally, it's a massive blind spot.
Finally, part 6, the final verdict and key variables. Here's our final institutional verdict on today's market condition, cautiously constructive to neutral. Look, yes, the AI supercycle fundamentals remain incredibly robust, and they are effectively offsetting the immediate drag of systemic debt. But make absolutely no mistake, the 10-year yield and that towering $40 trillion debt pile create a hard ceiling. It severely caps any immediate broad-based multiple expansion.
Which leaves us with this final, pivotal question to monitor. Will the impending September 15th Clarity Act vote, combined with the exact trajectory of these newly sized Treasury liquidity operations, fundamentally alter the institutional risk parity model? Keep your eyes locked on the actual size of those Treasury operations and the incoming regulatory votes, because these are the exact variables that will dictate the next major asset rotation. Stay focused out there, and we'll analyze the fallout in our next explainer.